Hello everyone and welcome back to the Saigal Sea Trade podcast. I'm Research Analyst Shruti, your host today, and we are diving deep into the fast-changing world of tanker shipping. From crude swings and CPP cracks to LPG rate rebounds, there's a lot happening out there. And to break it all down is Sandesh, our in-house shipping expert and someone who can make even world-scale numbers sound like storytelling. Sandesh, it's great to have you here.
Always a pleasure, Shruti. There is no dull day in tankers, and last week was no exception. Rates shifted, then we have arbitrage windows, they blinked open and shut, and as always, geopolitics kept everyone on their toes.
Alright then Sandesh, let's jump right in. I want to start where the noise has been the loudest. The VLCC market, of course. So what's the story this week? And the VLCC segment, like everyone's talking about, the fallout from those May OSP cuts and whispers of rising OPEC plus volumes. Walk us through what happened ex-MEG and how that translated across the board.
Absolutely, Shruti. Now let's start with the ex-MEG, that is Middle East Gulf. The lifeblood of the VLCC market. It is kind of a talking point of the town. Last week it began on a flat note with the minimal visible fixing and barely a whisper on the wires. So charterers, they were kind of operating quietly, almost in the stealth mode. And you know what? What really broke the sentiment was that sharp cut in May official selling prices by both Saudi Aramco and ADNOC. That was a red flag for oversupply. So think of it like this. If Aramco slashing prices, it's signaling barrels need to move, which means they expect more production or they want to stimulate demand. Either way, the market read that as bearish. Now combine that with the muted activity and long tonnage list, and you have got a classic recipe for rate erosion. We saw world scale 47.5 get printed, and that's barely minimum. That's the below operating break-evens for many owners, especially for scrubberless eco tonnage. Even as we entered the third decade of April stems, activity picked up slightly, but the overhang was just too much. So supply was far outpacing demand. We might see early May liftings offer some relief, but unless there is a material tonnage clear out or, kind of a macro level demand spark, we are stuck in the softening trend.
Alright, so let's hop west now. The WAF and the USG VLCC activity seem to be dealing with their own headwinds, but also a lot of noise around tariffs and Chinese retaliation. So give us the lowdown, Sandesh.
Yes, Shruti, West Africa, it was caught in a slow grinding decline. So rates edged lower through the week, driven by, subdued demand. But here is what added another layer. Softer sentiment in the both Middle East Gulf and Brazil that created a ripple effect. And you rightly mentioned the tariffs. The latest round of US tariffs and then the China's expected countermeasures injected uncertainty. Nobody wants to commit a big money when policy risk looms. So on the ex-US Gulf side, rates on the US Gulf China run fell from 8.5 million to 8.2 to 8.25 million lump sum basis, and from my perspective that's significant. And then we have a ex-US Gulf to UKC, it is also dropped to about 3.8 to 4 million. There was a brief blip in activity, but overall it was very tepid. Now what's really interesting is that if USD doesn't produce fresh cargoes in the next few days, we could be in for further softening. So charterers are kind of playing a waiting game right now. But here is the twist. If the sentiment swings, owner might start resisting those lower numbers. So we could see a standoff shaping up.
Thank you for that explanation on the VLCC market, Sandesh. Now let's pull in the Suezmaxes. They seem to be straddling that midpoint between VLCC softness and Aframax volatility. What's the latest out of the MEG and WAF corridors?
Great observation, Shruti. First of all, I would like to say that, the MEG Suezmax market, that is Middle East Gulf Suezmax market, it was opened on a weaker note last week. As we have seen, the demand was kind of a sluggish and the rates, they started slipping early in the week. But eastbound routes held up. Westbound saw a little more life, and thanks to a few US bound fuel oil cargoes and ballasters heading towards the WAF. But overall, the market was sluggish. In the West Africa, we saw a sentiment shift in the midweek, specifically when the CPC pipeline it was partially opened and it did restore some of the Black Sea flows. Now that created some bullish noise with the tonnage it tightened there and end April stems being covered. We could see rates push a bit higher. So TD6 they just dipped only slightly, but TD20 rose sharply to world scale 104.17. It's up by 8.7% week on week, and that's the momentum. And talking from the Indian perspective, Indian PSU also chipped in with the three cargoes, and the last one of them, that is XMEG, which is bound to West Coast India, it was done at a world scale 124. So there is a traction building.
So now moving on to the Aframaxes. We saw some tight supply out of MEG early on, but didn't last, right? What's going on there?
Well, correct. And absolutely pinpointing out that particular statement there. MEG Aframax market opened with the promise of modern ships. They were tight and sentiment was leaning towards the bullishness. But then the activity dried up as tonnage availability is increased and owners grew more willing to fix at a softer number just to avoid waiting. We have a TD8, it failed by 3.54% to world scale 47.79, and in the SEA region things stayed mostly flat. Demand for that specific crude it nudged higher for the third decade of April, but not enough to trigger any rally for tanker market. The tonnage level was balanced and inquiries was steady but uninspired. So it's a gently softening environment right now. Another benchmark, that is TD14, it bucked the trend slightly and it rose by just 1.21% to world scale 135. But that's more reflective of micro movements.
Quite an explanation, Sandesh. So let's shift our focus on clean tankers now. Last week looked rough across LRs and MRs, but there are interesting dynamics with naphtha and petchem margins. Please walk us through it.
It was a challenging week for clean tankers. LR2 on a TC1, it dropped by over 20 world scale points to world scale 129.44. And that's a big correction. Long haul cargoes, they dried up and without any arbitrage support, the sentiment just caved. In that particular route, TCEs also dropped by 17.6%. That's a significant decline. So it was concluded on just about $28,000 per day. Now LR1s, they followed with a 7.19 world scale point drop, and TCS were still decent but sliding around just about 20,470 per day. And even MRs on the TC12, they also lost the ground, down by 7.31 points to world scale 141.44. Now what propped the things up a bit was naphtha, and naphtha is kind of a primary commodity that drives CPP tanker demand. So we have petchem margins that improved specifically in the Northeast Asia, and crackers they stepped in to lift volume. So we saw a short-term demand kick in. But however, micro sentiment is right now shaky. A potential recession, then the weak refinery runs and industrial fuel demand remained a key risk. Also, in my opinion, gasoline flows are sluggish right now. ARA hubs, their stocks, they dropped 2.26% week on week to 1.428 million metric tons, but the market is barely reacted. And with the US port fees possibly hitting Chinese vessels, that uncertainty is another weight on the arbitrage.
Alright, that brings us to our last segment, the LPG segment. We saw east of Suez bounce while the west stayed quiet. What are the takeaways, Sandesh?
Yes, you have rightly said. East of Suez saw a strong fixing. We have seen 5 fixtures, those were concluded for second half of April. And then the benchmark Rastanura Chiba rates, they range from mid 50s to low 60s per metric ton. Australia fixtures were quoted above the index level, which supported that sentiment. But the market is closely watching China. The tariff reaction could sway everything away. For now, rates are stable to firm, and we hope that moment will continue for next coming weeks. In the West, it was a quiet market, specifically Houston Chiba via Panama. That route was hovered around $107 per metric ton. But Friday's US-China tariff charter hit confidence in the market. Rates, they dipped to $105 to $110 per metric ton. So in the short term, paper markets are taking center stage as, players digest the policy risk.
Alright, then that brings us to the end of this episode. Thank you, Sandesh, for joining us and sharing your insights.
Thanks, Shruti. Thanks for inviting me once again. It was a pleasure to be here and share my knowledge and experience with our audience. Thank you.
And to all our listeners, do not forget to share and subscribe to our podcast. And until next time, navigate safely and stay tuned.